The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Karen Cho and Juliana Tattelbaum, and these are your headlines. The White House says President Donald Trump could extend his deadlines to reimpose so-called reciprocal tariffs, including his 50% levy on the EU.
The deadline is not critical. The president can simply provide these countries with a deal if they refuse to make us one by the deadline, and that means the president can pick a reciprocal tariff rate that he believes is advantageous for the United States.
European Commission President Ursula Von Der Leyen says she's received Washington's latest proposal for fresh trade talks, but that a deal is anything but guaranteed.
We are ready for a deal. At the same time, we are preparing for the possibility that no satisfactory agreement is reached.
And the greenback continues to weaken, hitting a 3.5-year low against the euro and sterling as markets anticipate the prospect of Donald Trump appointing a more dovish Fed chair to take over from Jerome Powell.
We're conditioned to kind of listen to authority and spokespersons and think, that makes sense, that must be important. And it was so important, we ran it in my first headline. I'm sorry, I didn't understand a word that the White House spokesperson said in that bite. What? It was like a word soup of reimpose, reciprocal. But do you want to listen to it again? Did anyone else, could any of you understand? Just play it again and see if I missed something.
The deadline is not critical. The president can simply provide these countries with a deal if they refuse to make us one by the deadline, and that means the president can pick a reciprocal tariff rate that he believes is advantageous for the United States.
It is a little bit complex, isn't it? Pretty much we could go in that direction,
Am I
we
being
could go back in that direction, or we could pick that, or we could go that way.
You guys are really smart. I'm the one who has bouts of real thickness here and, a bit of a dope. I didn't understand a word she said. What? The deadlines are not critical. Yeah, they kind of are because they're deadlines. But if they're providing a deal, they're not doing a deal, we can have reciprocal and have reciprocal if they provide a deal and if the president gets a deal. I don't know what she's talking about. I have no idea what she's talking about.
Everything's up in the air. That's all you need to know, that things can be negotiated or they may not be.
I think the other point here is it's not just the reciprocal tariffs that are on the table unresolved here. You've still got sectoral tariffs to think about. And when it comes to the U.S. negotiations with a number of countries, we understand that there's hesitance on the part of many of these countries because they don't know where we're going to land on things like pharmaceuticals, on steel, on chips. So how do you come to the table on a country level deal when you still don't know how you're going to be impacted on all these other
Apologies to our
sectors?
viewers because we're supposed to inform, but I've added more lack of clarity. I've added opacity and fog because I don't understand the actual news.
Well, I'm not sure you have added lack of clarity because I think that was the message that came through from the White House. We're all counting down to this 9th of July deadline.
No, we're not. She just said the deadline's not critical.
That's the point. Now it's seemingly
the other bit I didn't get.
The 9th of July may not be some sort of magic date we get to and then we emerge from the other side. And let's face it, Liberation Day had that same impact. We all thought we'd get to Liberation Day, emerge from the other side, and finally, even if it was a sort of punishing news, at least there would be certainty for markets that we could get on with it. I think what we're getting through from this messaging is exactly the same thing as Liberation Day. There will be no pushing forward with this clear view on tariff policy come the 9th of July.
I'm so glad the markets have taken this on board and been really pragmatic and measured about it. Oh no, they've gone to record highs again.
Well, this is what I mean. What I was about to say. Have we learned our lesson?
No.
From April 2nd?
Never.
Markets believe that Trump would never go ahead
from
with
2007,
like
from March 2020. Have we learnt our lesson? I don't think so. We never do.
Well, the 90-day pause on so-called reciprocal tariffs is due to end on the 8th of July, and Trump's 50% levy on imports from the EU is due to come into effect on the 9th of July. Commerce Secretary Howard Lutnick told Bloomberg the US is working on, quote, the top 10 deals, while adding that the US and China have signed the trade understanding previously struck in Geneva. That's the trade truce. Now, meanwhile, the president has signalled that his administration will determine tariff levels on other countries where a deal cannot be agreed before the deadline. Trump officials have repeatedly signalled that deals are close, with National Economic Council Director Kevin Hassett telling Fox Business earlier this week that he expects to see a sequence of trade deals after Congress passes the Trump-backed tax and spending bill. Meanwhile, European Commission President Ursula Von Der Leyen confirmed the European Union is assessing the latest trade proposal received from the US. Von der Leyen did not disclose the contents of the proposal, reiterating calls for a deal while stressing that all options remain on the table.
I briefed leaders on the current state of play in our trade talks with the United States. President Trump and I had a good discussion at the G7 summit in Canada. Back then, we agreed to speed up the work with a clear goal, an agreement before the 9th of July. Today, we received the latest US document for further negotiations. We are assessing it as we speak right now. So our message today is clear. We are ready for a deal. At the same time, we are preparing for the possibility that no satisfactory agreement is reached. This is why we consulted on a rebalancing list, and we will defend the European interest as needed. In short, all options remain on the table.
UBS says changes in tariff policy are denting confidence in the US more than anywhere else. Aaron Captain is the chief economist at UBS and joins us now. Aaron, thank you so much for joining us. There's mounting evidence in recent days that there is a tariff effect still coming for economies. We saw it in the Nike commentary yesterday saying the implementation of price increases in fall. H&M was talking about more price competition, elevated prices in the United States. We've had central banks staying on the sidelines. Jay Powell concerned that we still have the onslaught coming. Is it all ahead of us?
Well, yes, and you can actually see it in the Treasury data, right? So the Treasury has basically daily data. You can see what they're collecting in terms of tariffs. They're now collecting at an annualized rate of $300 billion, right? So, of course, people then look at the CPI data and where is it? But it's imminent, right? I think the next month is going to start to show it. It's really the July print, though, which you get in August, that's going to, I think, fully capture, the extent of the tariffs.
It's one thing to see a step up in prices, and there's another to see a step up in inflation that is lingering. And that is the debate for central banks at this stage, and to the argument as to whether Trump is right and whether interest rates should be cut from here or whether central banks are right to be more cautious. Which one is it?
Well, he's not right. So I think there's a few issues with CPI, right? So one is that a very large part of the basket only gets sampled once every 2 months, right? So it's only New York and Chicago and LA that gets sampled every month. Now, there's a 2-month lag between the tariffs and CPI, so the May print was a March tariff configuration. Of course, that's before Liberation Day. The next print, June, is going to be the one that captures April, but even the June one, you're going to not fully see it because of the sampling issue, but also because firms are still drawing down the cheaper inventories. They might not have fully sort of had to switch yet to the more expensive replenishment of the inventory. So it's really sort of a little bit further ahead of us. I think July is sort of the start. And then you're going to have a 5-month period where I think we'll really see sort of goods prices ramp up and reflect what's already happening in the Treasury data.
And I think we're all sitting here a little bit puzzled as to why markets have run away with themselves again. I mean, we're back at the highs for the NASDAQ, the S&P 500. Can you give us a little bit of color on what your clients are asking about, talking about, to maybe give us a sense of what's driving the market narrative?
So 2 elements to it. One is what Steve was referring to earlier, is that we were promised 90 trade deals in 90 days, and we got one. So if you're trading the market, you don't want to be short if there's the risk of constant sort of trade deal headlines, right? So that's sort of one thing you're navigating. And then on the other hand, even if you are bearish on tariffs, the data deterioration could be a few months ahead of us. So there's a timing mismatch between sort of concern and I think how you have to trade the headlines. The other is, though, that I think a large part of our client base really does believe in the taco trade, right? And I think that the interpretation of sort of taco or Trump always chickens out is very different from my interpretation, right? So yes, there have been pivots, but the pivots have been at very high levels of escalation, right? Going from 145 for China to something where we are now. It's not going to sort of a zero tariff environment. And I think that's sort of the danger here, is that everyone's getting stuck with the base rate of 10. We got the sectoral tariffs still to come. which are really going to keep, I think, the weighted average pretty close to where we are today.
And it seems like, based on the reporting that's out there, that trade deals have been harder to come by because countries are waiting for clarity on the sectoral tariffs. It's not just about what happens at a country level. Is there a sort of inflection point when it comes to the tariff level where companies won't be able to absorb the tariffs and it will have a bigger impact on prices? And if so, what's that kind of level?
Yes, look, that's a very hard question. So I think, when we were at the April levels, that was sort of prohibitive for business, right? And that's when we had all the debate about how importers didn't have the cash to pay for the tariffs, we're going to have supply chain shortages. That's sort of one level of disruption. We're no longer there. And I don't think you're going to see the level of supply chain disruption that people feared a couple of months ago. Now you're sort of in the zone where you have to figure out, how much can I absorb in my margin, how much market share am I willing to lose? And really no one knows, right? And so the whole debate around maybe what's happening in the CPI data is that the firms are all absorbing it in the margin, right? Now, I don't believe that. Maybe it's the case because then people extrapolate from the Amazon stories that large U.S. firms will be able to take that impact on the U.S. consumer and distribute it across the whole world and then mitigate the impact in that way. So I think that's why there's so much uncertainty. I sort of believe inflation is going up, but there's a very wide confidence band by how much it goes up.
But isn't it, I don't know, let's go back to grassroots. Isn't it obvious why the market's going up? Isn't it so bleeding obvious? And the fact is, governments are run for a whole host of reasons, not just for pure economic rationale. Companies are run for pure economic rationale. Companies are run for shareholders. Shareholders demand profit. They demand great execution, whereas governments are run for a whole host of reasons. I mean, it's like the UK at the moment. Look at the latest 3 data things in the last 24 hours. You've got the lowest car manufacturing since 1949. I mean, it's a disgrace where we've come to. You've got the governor of the Bank of England said, yeah, it is. It's the NICs. It's the government policy on tax, which is causing companies to not hire as much as well. So you've got those bits. Oh, yeah, plus the fact you've got the reform, the welfare reform bill last night where the Prime Minister caved in, which means that Rachel Reeves got to find more money from somewhere. And where's it going to come from? It's going to come from taxpayers as well. So isn't it that obvious? People are buying companies because of bottom up, because, all right, they may be fruity valuations, but the fact of the matter is they're fruity valuations for well-run companies. You might not like the price of Nvidia, you might not like the price of Nike, but you know that Jensen Huang and Elliott Hill are good at their job.
Yeah, I think you've seen everyone come back into the Mag 7, right? So, or Mag 6, I should say. But so so that's part of what's happening, and I think the whole rotation debate has lost a bit of momentum, right? So while you see it in Eurodollar and FX markets, when you look at the relative performance of equity indices, you're not seeing any rotation, right? And even in, I think, the relative performance of bond indices. And so just by having de-escalated and having reduced the recession risk in the US, it's not that obvious that on sort of a 2-year horizon or 3-year horizon, your return is better by not being in the US, right? And so I think it does very quickly move a large part of the investor base, at least back to where they were pre-Liberation Day.
Aaron, having said, and I get what you're saying, but I love the dynamism of American companies. I admit sometimes it's a brutal form of capitalism. The Jack Welch GE model was, okay, we can analyse it, we have analysed it, it's been analysed more than perhaps any other business model. But the fact of the matter is the dynamism of US companies is phenomenal compared to European companies, isn't it?
Yes, so I'm not disagreeing with you. But of course you have to
can you imagine Americans worrying about the size of UBS the way the Swiss do?
Take the S&P 500 though, right? I mean, the 493 look very different from the Mag 7, right? So you have to be a little bit careful, I think, in sort of painting every company with the same brush. And when you think now about sort of the impact of the tariffs and the fiscal bill, the way small, medium-sized enterprises are affected is just completely different from, I think, the big sort of very efficient, innovative companies are being affected. So, and it's not that obvious when you look at the 493 that they're that different from, I think, a large part of the European companies, right? So for about a quarter of the European index, we have companies that are completely dominant in their sector and actually much more competitive than U.S. companies. So I think you can go on and on about sort of what those companies are. Now, it's true that on average, I think you have higher innovation rates, you have higher growth rates, So all you say is sort of true, but so now it's just a judgment. I mean, I'll give you one example that's really sort of pulled the two markets closer together, right? It used to be the case that US buyback rates were way higher than European buyback rates. Those are now equal, and actually for some of the European countries, they're higher than the US rates. So it's no longer that obvious. The US has added 45% or 46% of GDP to their debt in the last 15 years, right? That basically allowed them to grow faster than Europe, right? Europe didn't do that. Right? So if you start to sort of subtract all those temporary things away from what was propping up the US market, then I think they are actually much closer together. Now, it still doesn't sort of detract from your point that I think we have a lack of sort of innovation and AI theme in our market for people to get excited about.
I know where I would rather have been placed for the first quarter, or the last quarter, 49% are the ARC Innovation Fund versus 0.7% on the European stock market. I mean, that is quite a wild gap. That's not
actually a very fair comparison, is it?
Well, I mean, that's
you've taken
the gap.
one of the raciest tech-focused growth funds versus the broader European market. There's not kind of a fair comparison, is it?
Well, I don't know. I mean, this is the rotation, isn't it? Would I rather be in US assets? Being in US assets in recent years,
but that's a very specific part of US assets.
But being in US assets in recent years has been chasing things like technology or chasing the ARC Innovation Fund versus a rotation to Europe to something safer with a growth profile was the StockStrip 600. So I think some have actually made that diversification debate. I want to come to a different point, and the undercurrent has been around the Fed chair, Jerome Powell, this week, and whether his shadow could be replaced sooner rather than later, and what that could do to the thinking around the central bank policy. We've seen some action already in the dollar. We've seen some change in the thinking around 2026 on interest rates very early on, and I think that has some bearing on what technology stocks also do from here. How are you piecing it together?
Yeah, it's a bit of a curious debate, frankly. I mean, it was always obvious that if it's not going to be Waller or Bowman, who are the existing sort of Trump appointees on the board, then he has to use the Kugler vacancy in January to basically appoint the next Fed chair, because he cannot risk waiting or hoping that Powell actually steps down in May of next year. Powell has the ability to stay on as governor if he wants, right? Now it would be unlikely, but it's possible. And so he has to use that Kugler slot. Now the nomination for the Kugler slot was going to be in Q4. So then a news story comes out and says, well, he might appoint in October. Well, that's exactly what was supposed to happen. So now if he did it tomorrow, then I think you have a much longer period, obviously, of sort of a shadow Fed chair, which would be more problematic. But ultimately, it's also going to depend on who it is, right? So if this person gets nominated in October or whatever the month is going to be, and that person is then very restrained in public commentary, there's not much of an issue. If the person starts to publicly comment every other week about what the Fed is doing, it's sort of a little bit more awkward. It's not obvious to me that it's going to have any impact on what the Fed actually does before May of next year, or potentially even thereafter. It's a committee, right? They're not going to do whatever the chair tells them to do, but it's going to be publicly, I think, disturbing for markets, and it's going to create more uncertainty about what might happen sort of after May of next year. So I think it's a little bit of, it's one of these things that, the headline comes and it's another reason to basically, extend the trend that was already there in Eurodollar, and so you break 17, and I think that's all it was. I don't think there's a lot of new news here.
And just lastly, you mentioned Waller and Bowman, and earlier this week we were talking about how they really put July as on the table for a rate cut. Do you think that those comments were politically motivated?
So for Waller, we track sort of speech. We have this AI model where we basically track sort of what everyone says sentence by sentence. Waller has been consistently more dovish now for the last 6 quarters. So for him, it's much less of a shift. For Bowman, it was a big shift, right? So I'm not going to comment on their motivations, but it's interesting when you look at our tracker, as Powell has gone more hawkish and Bowman and Waller have gone more dovish. So there's some neutralization, I think, of that shift happening at the Fed.
Yeah, interesting using an AI model for it. That's another intern that UBS doesn't need, isn't it? It's happening. It's real, isn't it? Aaron, lovely to see you. Thank you very much indeed for joining us, and have a brilliant weekend. Aaron Captain, who is the chief economist at UBS. Coming up on the show, EU leaders meet in Brussels with trade and geopolitics top of the agenda. Plus, we'll get a key inflation print from France. Those figures due on the London wire. Well, wire is at 7:45 London time. And we're going to dig into AI. Wait for it. AI, dating and connections. Yeah, that got you lot interested, didn't it? With the Grindr CEO, George Arison. That conversation, 9:30 London time.
Welcome back to the program. European Council leaders have pledged to give continued financial support to Ukraine as well as support its reconstruction as part of Kyiv's path to EU accession. The Council also called for the adoption of the latest proposed sanctions package on Russia, with further measures urged by Ukrainian President Volodymyr Zelensky during his address. On the Middle East, the Council reiterated calls for an immediate ceasefire in Gaza and release of all hostages, condemning the dire humanitarian situation in the enclave. Not everyone was pleased with the outcomes of the meeting, with Hungarian Prime Minister Viktor Orban agreeing when asked if the European Council had been his roughest yet. Sylvia spoke to Viktor Orban yesterday, and she's been speaking to EU leaders throughout the last 48 hours in Brussels. Sylvia, good morning. Talk us through the conclusions from this meeting and where we stand right now. I know there's a lot of focus on trade as the next flashpoint in the EU story.
Very good morning, Juliana. Indeed, trade was perhaps the most important discussion at the EU summit yesterday. The bottom line there for our viewers, it is very clear that the European Union wants to have a trade deal with the United States as soon as possible. That July 9th deadline is fast approaching. But ultimately, and they have just received the latest proposal from the United States, they don't know if a deal is going to be actually achieved. All ultimately depends on the President of the United States. So, of course, we'll continue to monitor the conversations around trade, but I want to focus on foreign policy for a moment, because the reality is that this European summit was actually quite weak when it comes to foreign policy. If we think about the language around the Middle East, around particular some of the actions of Israel, the European Council was actually showing a little bit of division here when it comes to what sort of actions the European Union is going to take next. So the focus when it comes to that is back on the foreign affairs ministers. So once again, when it comes to that, we have to wait and see what will be decided at the ministerial level. But if you focus on Ukraine for a moment, and the president of Ukraine actually attended this summit online, he had been away from Ukraine for several days. So he explained to the rest of the leaders that as a result, he had to go back home. But nonetheless, he had an important message for the European Union, and that was around that they need more support and they would like to see more tougher measures on Russia as well. When it comes to Ukraine, once again, we witnessed what had happened already at the last summit. The agreement at the end of the summit only includes 26 countries. Hungary still opposing giving any sort of language when it comes to Ukraine potentially joining the EU. I had the chance to speak to the advisor to the Prime Minister of Hungary, whose surname is also Orban, and he explained the position of Hungary when it comes to Ukraine joining the EU.
For us now in this summit, the most important issue is the accession of Ukraine into the European Union, because I understand that from the American perspective, the NATO membership is the most important, and the rejection of NATO membership of Ukraine to the NATO. But here in Brussels, and right now for us Hungarians, the most important issue is the EU accession of Ukraine. So we organized a public referendum when we collected 2 votes of the Hungarian people, and like an overwhelming majority of the respondents were rejecting this idea because they were considering it as a danger right now for Hungary. Because if we integrate Ukraine into the European structure, then we integrate the war between Europe and Russia. And this is
what about when the war is over? Can you say yes to Ukraine joining the EU?
Now it's hypothetical. Now we have a clear decision for the short term on the Hungarian side, where the Hungarian people said that they don't want to take that risk.
So Budapest, they're sticking to their line. They do not want to see any sort of progress or even conversations when it comes to Ukraine joining the EU. But behind the scenes, there's a strong effort from European officials to do the groundwork with Ukraine, at least in a way that it is perhaps seen as informal, but allows Kyiv further down the line to become a member of the EU. So this is the way that the 26 members of the EU are managing to circumvent, to some extent, the opposition from Hungary. But there's a point, however, where they cannot circumvent Hungary, and that is the point of sanctions. It was clear that during the summit yesterday, the leaders were suggesting to the European Commission to develop that 18th package of sanctions against Russia. But here is the political advisor to the Prime Minister of Hungary suggesting that the EU should only move forward when it comes to sanctions against Russia if they get the green light from the American side first.
This thing is not weakening Russia, as it was told that it's going to happen, but it's weakening us, Europeans. So
is the answer perhaps stronger measures against Russia?
Yeah, but then we completely destroying ourselves. Why it would make sense? So the original idea of the sanctions regime was, as it was described to us, that they wanted to create a situation where Russia gets weakened through the sanctions. But the opposite happened. The Russian economy is doing well. They are building up new kind of supply chains, which is also a challenge for the United States in a great power competition, and it completely destroyed the European economy and the European competitiveness. So, according to our understanding, if something is not working, it makes no sense to further push it. But
even if the United States were to say yes to new sanctions on Russia, because they are considering it,
I think that
if the US does apply new sanctions on Russia, should the EU do it as well?
So what we think is we should act in a coordinated way together with the United States. What President Trump wants is he wants to achieve peace. This is a completely new way of understanding things, and we are very grateful to that. So, and he opened the negotiations directly with the Russians, which is a very good news. And we think that the Europeans' job in that field should be support the United States peace initiative.
So let's see what will be the actual proposal from the European Commission when it comes to new sanctions on Russia. The Prime Minister of Hungary earlier today was already suggesting that if there's any sort of measures that involve energy imports into the EU, Budapest would not be supporting that package. And of course, you need unanimity in order to see new sanctions applied on Russia. And just a final point to say that whatever that proposal is from the European Commission, the 18th package of sanctions against Russia is already weaker than what the European Commission President suggested a couple of weeks ago. She had intentions to include changes to the oil price cap, but that idea is no longer on the table, at least for the time being, after the United States reportedly opposed going into that direction. So let's wait for that detail, guys.